Hello everyone and welcome back to PFJ. Today we're going to talk about health savings accounts, or HSA for short. Now, what are these accounts? These accounts are accounts to help you save money for medical expenses. Now, why do we even need these accounts? Well, these accounts help you save tax. Just as we talked about retirement accounts and how they save you on one type of tax to create incentives to save for retirement, the government does the same thing with health savings accounts. They give you incentives in the form of paying less taxes and saving money, so you would save for your medical expenses. Now, we're going to go back to our old scheme of what is an investment account, because retirement accounts or health savings accounts are basically special forms of investment accounts. If you guys have not checked out my video on retirement accounts, link up above, please check it out. So we talked about how you have your salary. This goes into an account somewhere, and this is that investment account or that bucket that it sits in. And over some years, that account grows and that envelope gets a tad bit bigger and bigger and bigger. And then at some point later, you take the money out and then woohoo, it's your money. And in this process, you get taxed here, meaning on your salary, and you get taxed when you take the money out. And we talked about how being taxed on your salary, we can say that you get taxed when you put the money into the account, and how getting taxed when you take the money out of the account is being taxed on the account. Other ways to say these things is to differentiate them by when the taxes are being paid. So when you pay the taxes first and then you put the money into the account, we call these post-tax accounts. On the other hand, when you put the money in first, the money grows, and then you pay taxes, we call these pre-tax accounts. And we went over how both of these things are good and bad and how they can be helpful. Again, check out my videos on the basics playlist on my channel. We go way into details about all of these things. We talked about how in post-tax accounts, you have little money, and since the account is going to grow over time, that money is going to grow over time. So you'd rather pay taxes on a little money than a lot more money. And that's how you save money here. And then we talked about pre-tax accounts, meaning because you're putting the money into the account first, your salary as a whole is less. Because your salary is less, your taxes are less. And this is done because your salary is less, the last bucket or bracket in your tax brackets gets filled less. And as a result, you save a lot more money. And that's how the pre-tax side helps. So in this specialized account, you save on post-tax income and you also save on pre-tax income. Now, there's one part of this that we have not talked about, and that is the growth. So you might say, wait, how does that work? You're saving money on the whole of the account. So growth is part of that account. So you save taxes on that as well. That makes sense. But there is a whole growth phase that we didn't talk about previously that I would like to talk about now. Now, what growth means is that whenever you have an account, so let's go back to our drawing of an account. Over some time, this is gonna become a much bigger account, right? Because it's invested into the market, ETFs, whatever it may be, this account is gonna get bigger. But in the process of that happening, it's going to have ups and downs over the years. And that's just the market moving up and down. And in those ups and downs, you might buy stock, you might sell stock. And as you do both of those things, you might make a profit or you might make a loss. Now, when you make a loss, the IRS is not going to tax you on the loss because you have no money, so we don't have to worry about this. But when you make a profit, you technically are making money. And the IRS wants its taxes on that. So you do have to pay taxes on those things. So in a normal investment account, as you do this part of things, you do have to pay taxes. But in this type of account, you do not have to pay taxes on that buying and selling or on that growth. And that's another way that this account does save you on taxes. So going back to all the ways that this account saves you money on, we save money on post-tax because we don't have to pay taxes on our salary. We save money on the growth because we don't have to worry about the ups and downs of the market and how that works. So we save money there. And then we save money on pre-tax, meaning when we take the money out. And that's why sometimes this account is called triple tax protected, because you save taxes on so many different ways. Now let's talk about how is this account actually works in real life. How does this account gets used? Well, you have your account, and this account is going to get bigger over its life. Now, whenever you have a bill come, you can pay it from your salary, meaning you earn money, pay taxes on it, and then you got your salary, and then you pay that bill through that salary. Now, this is technically post-tax money that you're paying off of, or the other thing you can do is pay it directly from this account, meaning you did not pay taxes on the money sitting in that account in any which way. So you save a little bit money that way, and you can keep doing that over the years, and over the years. And that's how you can use this account. You will literally sometimes get a debit card, and then you just pay whenever you need to go to the doctor, buy your medicine, pay for a procedure, pay for surgery, whatever it may be. Now, what ends up happening to this account as you do that is, say you put money in, the account is growing, is with the market is growing, you take some money out, it goes down, then it keeps going, then it goes down, then it keeps going, then it goes down, and then it keeps going, and then it goes down, and then it keeps going. Versus if you had left the money into the account, this becomes a much higher curve. So at the end, because you kept taking money out, the account might not grow with as much money when you start to retire. It doesn't compound as fast if you keep taking money out. And for that reason, a lot of people will just leave the money into the account and let it grow. But you'll be like, wait, if they leave the money in, then what's the point of having the account? What they end up doing is, as they keep getting all these bills over the years, paying for medications, going to the doctor, whatever it may be, they put all these things, they save all these receipts in a basket somewhere. And then when they're about to retire, they take all these receipts and they put it against the account, and then they take the money out. So they leave the money into the account, and the money keeps growing over time instead of taking it out every so many years. So at the end, when they're about to retire, they have much higher money into the account than they otherwise would, because the money can compound from year to year uninterrupted. Now, this is also a great way to need money during emergencies, because say something big happens where you need money for, you have all these receipts saved up. You just go to your HSA account, take the money out, and then you're good. So a lot of people end up using this money as a sort of an investment account, as a sort of a retirement account that they can use later on in the years and save money on. So that is what's an HSA account. It's an account to help you save for medical expenses, and it just basically saves you on taxes. Instead of just saving you on one or another form of taxes, it saves you on all three different types of tax savings. We talked about post-tax accounts, meaning you don't have to pay taxes when you put the money into the account. We talked about pre-tax taxes, meaning you don't have to pay taxes when you take the money out of the account. And then you also don't have to pay taxes on the growth of the account, meaning if you want to buy, sell stocks, the money goes up and down, you make some money, you do not have to pay taxes on those. We talked about how this account is supposed to be used, meaning you put the money in, the money grows over the years, is invested. Every time you need to spend the money, you use the card that comes with it, you pay off the expenses, and then you're good. But every time you do it, you lose a little bit of money in the account, and then over years, the growth on the account is less than it would have been otherwise. So what a lot of people do is they pay all those expenses through their salary and save those receipts in a box somewhere. It could be digital, it could be physical, whatever it may be. And when they retire, they basically take all those receipts and take the money out at that point. This can also be a way to save for emergencies, meaning something's coming up. you don't have the money for it. You take all the receipts, put it against the account. Now you have money for that emergency. I hope this was useful. Next we'll talk more about the logistics of this account, the eligibility, how to set one up, and all those things. If you like this video, please like, share, and subscribe. I would really appreciate it. Notes will be available on my website, pfjourney.com. Have a good one.